All right. Well, good afternoon, everybody. Thank you all for joining our Energy Funders webinar. I'm Laura Palmer, the CEO of Energy Funders. The first thing I'd like to go over a little bit of housekeeping. We won't be able to hear you speak in the webinar, so if you have questions, go ahead and type them in the little box on the right. And at the end, we'll have a Q&A session where we'll go through the questions and do answers at that time. I believe most of our participants are new to Energy Funders and our platform, so I'm going to start out with a brief introduction. All right. Energy Funders is an online investment platform that provides access to private market, energy, and Bitcoin mining investments. We streamline the investment process with our digital platform, and we give our investors access to asset classes that were traditionally unavailable to the public. Our ultimate goal, of course, is to make above market returns. Our team is awesome. We have years and years of experience in oil, gas, and technology, and we personally vet every single project that we invest into and try to select only the best investments for our investors. So to give a brief overview, today we're going to review our investment thesis, and Ross is going to go over our macroeconomic perspective, the potential tax benefits associated with investing in oil and gas, our current Yield Fund I offering, how this all works, and we'll have, as I said, a Q&A at the end. So let's kick us off by introducing our management team. As I said, I'm Laura Palmer. I'm the CEO. I'm a geologist by background. I've worked at large public companies as well as small private companies, all in oil and gas. And a few years ago, I raised private equity sponsorship to run my own oil and gas company up in the Powder River Basin in Wyoming. Jeff Allen, who you'll be hearing from also today, our Director of Business Development. He's an independent geologist, has been at it for a number of years, and he knows how that sausage is made. He's top notch. Piyush Prakash will not be joining us today, but he's our Chief Technology Officer. He has a lot of experience in everything technological. He's amazing, but most importantly, lots of experience in the crypto space. Nav Bell is our chairman, also not joining us today, but he has a breadth of experience in public companies, including EOG and Apache. We've got Matt Milligan, who is on the phone as well. He's our CFO advisor. He'll be chiming in on any of those burning finance questions you guys have. Ginny Urban Light is not on the call either, but she's our VP of Reservoir Engineering as well as Regulatory Affairs. She does a lot of things, lots of hats. Ross Hendricks, you'll be hearing from as well. He's our VP of IR and Communications. He is formerly from Stansbury, and he is our financial brain guy. He's got a lot of really interesting content that he puts out on markets and finance stuff. Jackie Lang, of course, last but not least, is moderating this to make sure that everything goes well. Thank you, Jackie. She's our CMO and one of the newest members of the team. So the next slide. So the first thing we'd like to talk through is our investment thesis. Why does Energy Funders exist? What are we trying to do? And I'm going to kick it over to Ross to review.
Sure. Thanks, Laura. Yeah. So we think that the high-level oil and gas kind of macro story is kind of just one of basic supply and demand. As you probably have seen in the news and stuff, oil prices have been on a kind of a tear this year, and we think that's kind of just the beginning of this cycle that's been playing out for really ever since the pandemic started. Things kind of changed where, historically in the oil markets, when you would have high prices, it would attract capital into investment, and that would bring production online. But ever since kind of the pandemic, and then the next, I'd say, especially in 2021, we've seen this weird dynamic occur where even with higher prices, it's the market is no longer able to pull capital into investment into the oil and gas the same way that it used to. And we think a big part of that is the new ESG movement. It's people believe that oil is kind of this dirty fossil fuel that we're moving away from. And so it's just preventing a lot of capital from coming into the space. And we obviously disagree with that. We think oil is a critical fuel source for humanity. It's done great things to lift people out of poverty. And the most important thing is, regardless of kind of your belief, it's that every major forecasting agency, including the EIA, is now forecasting a full recovery from the pandemic and record highs in crude demand in 2022. And so the demand story is basically looking better than ever. The supply seems to be impaired because of ESG and all these other factors. And so it's a really great positive price outlook that we have, and we think it's going to continue. The second big factor is, as everyone probably also knows, inflation is running at, this chart is a little bit old, but the recent inflation prints are the highest in 30 years. And during an inflationary environment, historically, energy is one of the best performing asset classes. You could look back to the 1970s to kind of see energy was basically outperformed every other sector of the stock market. And this year, that's also true. Energy is the top performing asset class in the stock market. And then the second component of that is the Bitcoin angle. Bitcoin is also becoming one of people believe it's becoming a global inflation hedge. And so with that, I'll kind of pass it over to Laura. She's our Bitcoin guru, and she can tell you more about that.
I don't think anybody's actually a Bitcoin guru, but I'll take it. Thank you for the compliment. So something that we are working on that I'm personally very excited about is attaching Bitcoin mines to select natural gas wells. We take the natural gas, we convert it to electricity at the well site, and then we use that electricity to power the mines still on the well site. The most compelling part about this story is actually the fact that I like to call it a digital pipeline. You could either send your molecules to a physical pipeline or you can send them through a digital pipeline. But the digital pipeline will currently fetch about 4 to 8 times more value at the wellhead than producing natural gas into physical pipelines. This means that at current pricing, instead of $4 to $5 per measurement of gas, per unit of gas, they're measured in MCF, we could potentially make closer to $30 to $40 per measurement of gas, the same thing. Obviously, this gives us a huge uplift in our wellhead economics. And of course, we pass that along to our investors in the form of either Bitcoin or dollars. Jump to the next slide. I'm sure everybody here is aware of the increase in visibility of both Bitcoin and crypto over the past several months. I know there's going to be a lot of questions about this, which I'm happy to field at another time, but I'm going to give my best to do a brief summary of kind of what Bitcoin is. It's a decentralized digital currency that is intentionally very scarce. The scarcity basically does 2 things. Number 1, it acts as an inflationary hedge. And number 2, it's absolutely causing this scarcity premium. If there's only a few of something, everybody wants them. To my knowledge, no other company in the market is actually offering fractional ownership in Bitcoin mines. And what's interesting about this is that because we're partnered, we are experienced in oil and gas, we are leveraging our experience in that oil and gas, using the gas to basically pass down cost advantages to our investors. Effectively, that makes it so that our price per coin at the mine is $12,000 instead of what you would be paying today, which we're down a little bit, but that would be like $50,000 per coin. Our team does have experience in both the crypto and Bitcoin mining space, and we've added additional advisory roles to ensure successful deployment. The other thing is that the market's recognizing the value of this. It's becoming mainstream, and publicly traded Bitcoin mining companies are commanding just ridiculous valuations. So we're trying to take advantage of that. There's clearly an arbitrage opportunity, and EnergyFunders wants to be at the forefront of that. So the next slide. So next, we're going to talk about the tax benefits of investing in oil and gas. And Ross is our local specialist for this. So if you would take it from here, Ross, that would be great. Thank you.
Sure. Yeah. So we'll go back to the 1970s where we just left off with the inflation story. It's interesting how these 2 themes are kind of coming back together. But basically, we all know that tax rates are probably going higher. And even if they're not, they're already pretty high, right? So the nice thing about oil and gas, and just as a precursor to this, to get these tax benefits, there's 2 things you should keep in mind. The first is you always should talk to a tax advisor because we're not tax experts. This is just general information that we're putting out there for you to kind of consider how it applies to you personally. But there's 2 ways to participate in these direct oil and gas investments. You can participate as what we call as a general partner. It's not technically a general partner fund, but we're calling it the GP fund. The key there is it gives you access to take these deductions off of your active income. So you can take them off of wages, salaries, things like that. The other way and then the key there is that you take on unlimited liability with that participation. And so the unlimited liability is what allows you to take the tax benefits off of your regular income. We have various means of limiting that liability or kind of controlling that risk, and we can talk more about that. But just want to put that out there. The second way to participate is through the limited partnership, and that caps your liability, but then you can only take these deductions off of your passive income. So it can basically go to offset if you have income from stock dividends, interest from a bond, or things like that. So with that precursor out of the way, the nice thing about the oil and gas industry is it enjoys some of the best tax benefits of the tax code. And the reason for that is because if you go back to the 1970s, there was an oil crisis. Some of you might have been around to experience that. It basically crippled the economy and unleashed really painful inflation. And so as a result, politicians decided, let's encourage as much as we can domestic oil and gas production. So they created a whole bunch of tax benefits to encourage small producers of oil and gas. The three key benefits that they created are, the first two apply to the upfront investment you make. And so it's the upfront investment is basically classified into two components. There's intangible drilling cost and tangible drilling cost. Intangibles are things that you can't recover later on. So things like labor and equipment rentals, that capital is just sunk once you spend it. And that's typically about 75 to 80% of the well cost. The second component is tangible. These are things you can recover. So any kind of physical equipment on site, wellheads, surface equipment, storage tanks, things like that. This is typically 20 to 25% of the well cost. In the past, you could only deduct the intangibles upfront, and the tangibles you would be depreciated over, I think, a 7-year time frame. But we're in this unique window because of the tax law change in 2018. Up through 2023, you can now deduct both your intangible and your tangible cost in the first year that you make the investment. And that's a really powerful benefit because when you combine those two together, it's roughly 95% of the well cost. And so for every dollar that you invest into an oil and gas well, you can write off basically 95% of that against your income, depending on whether you choose to do it as an active or a passive participant. And then the third key benefit is the depletion allowance. The nice thing about this is it never expires. It's with you for as long as you own the investment. And what this does is it takes 15% of the gross income off your tax bill, basically. So for every dollar of income you earn, you're basically paying taxes on about 85 cents of that. And again, that's regardless if your cost basis falls below zero, you get to keep accruing that benefit year after year. And so here's just to put it in tangible terms, an example. We've got a guy here that say makes $500,000 a year. That puts him in the 35% tax bracket. And he wants to make a $100,000 investment into a GP type of fund where he's taking on that unlimited liability so he can apply this against his active income. So in this case, he makes the $100,000 investment. He gets classified that of that 100,000, 95% qualifies as the IDC and TDC upfront deduction. And then based on his 35% tax rate, he's going to save $33,250 of his current year tax bill. And so one way to think about that is he's getting a $100,000 investment for an effective cost of about $66,000. So you can see it's a very powerful upfront benefit. And then the final piece here is this doesn't even factor in the ongoing depletion allowance that you're going to get at 15% every year. And with that, should I pass it back to Laura?
Let me just mention this real quick as well. There are tax deductions from Bitcoin as well. There's some discussion in the tax circles about whether or not those would be active or able to be deducted from your active or passive income, but we are aware that there are tax deductions too. So we're trying to make sure that we keep that in mind as we build out these funds. All right, so now let's get into our current offering, our Yield Fund I, and I am going to pass it over to Mr. Jeff to give you a very exciting overview. Jeff, you're on mute. That's a 2020, 2021 issue right there, isn't it?
Can you hear me now?
Yes, good job.
Okay, great. Wow, I did it. So what we're trying to create here when we started as a young company is we wanted to offer something unique. We wanted something with great tax benefits and then also above market returns. Usually you don't have both of those in one fund, and that's why I think the Yield Fund is very unique. We're targeting above market returns 100% plus IRRs given today's amazing prices. And not just in Bitcoin, but also in oil and gas. Within our fund, we're hoping to eventually do 50% in this yield fund. It's a blended fund. So 50% will be in the Bitcoin mines and 50% will be in oil and gas projects. The monthly distributions, this isn't necessarily a good fund if you're excited and need monthly distributions because they will be smaller. We want to keep as much of the cash in the company to keep reinvesting over the life of the fund, which is 3 to 5 years. But you will get those 10% of net income. And our main goal here is to have a really big sale at the end of the fund, and that's where you get your big yield. This group is owned by Paleo Resources, which is a great company by Roger Bro and Paul Black, very famous people in oil and gas. So we have a great group within the fund, but also the parent company knows what they're doing. They've been in business for over 30 years and have been very successful. So if you're looking for those tax advantages and the market returns right now with where prices are, this is a really good place to start. When it comes to diversifying, we mentioned earlier oil and gas and Bitcoin mines. On the oil and gas side, we want everything to be low risk. This is our first fund coming out of the gate as a new startup. So everything we're going to do is low risk. On the geology side, we'll be doing low risk, meaning we know where the oil is. It's just a matter of how much will come out. The technical risk, we don't want to drill anything that's very expensive. We don't want to drill anything that's too deep. And the liability risk, we don't want to drill anything that's has too many options of increasing liability, because this is a GP investment for some of you guys. So we're trying to use all of our, not just the owner's potential, but our group potential to find low risk opportunities, both producing and things that will be producing. We'll get into that in the next slide. But then Bitcoin mines, the interesting part here is, Laura mentioned it earlier, there's not a company that allows a general accredited investor like yourself to invest at the mine. And there's a lot of talk about mining, but very few people are doing it. And we know all those players in the field. But what we're doing, and that's what's different, is we're owning from nose to tail. So not only are we doing off-grid, you hear that in the news. Off-grid just means we are not plugging it into your house, right? Or an office space. We are off the grid of your city. And there's a lot of benefits to that. One, you get to produce Bitcoins at a much lower price. So our price is about 2.1 to 2.6 cents per kilowatt hour, where our competition is about 6 cents per kilowatt hour. So that's a huge win. And that's why when you own the mine, the generator, and the wellhead that has the natural gas, you're already ahead of your competition and your soon to be competition. Next slide, please. As a startup, we were raising money without necessarily a proven track record, but we finally drilled our first well not too long ago, and it was a very good well. It's 200 barrels a day. Once again, you can kind of see on this map, when I mentioned earlier about low risk, we were getting higher. So if you just think of a mountain, there was a well down here that produced, and we were able to get higher and produce 200 barrels a day. So we knew that there was oil in the system. We didn't know exactly how much. Initially, we thought it would be 100 barrels a day, ended up being 200 barrels a day. So we got lucky, but we're taking this on in stride, and we're drilling a lot of other wells right now in our pipeline. So the yield fund projected returns, we're looking for 100%. Our targeted potential is 100% plus IRRs. And the way we do that is splitting the oil and gas between proven production. So you can go in the market and buy production, and that's a nice hedge, but you really get the big potential when you drill PUDs, or proven underdeveloped drilling, which is the Parker 10 I just showed you, as well as the Bitcoin mining. The economics there are phenomenal. Whether you're a big Bitcoin person or you don't care too much, if you're interested in making money, it's a great place to be right now. Our fees, pretty simple. 5% origination fee. If you look at the chart, it decreases the amount you put in. And I know all of you will put in $1 million, so you're only going to have a 1% origination fee. And then our asset management fee is 2% spread over a year. Next slide. So whether you do the GP on the left or the LP on the right, the big difference there is your minimum investment is $50,000 for the GP and $5,000 for the LP. And the other big difference you'll see here is liability. So if you really want tax savings, you have to be on the GP side. That's where you see more of the tax benefits. And when we try to create how do we offer these great tax benefits and great market returns to our investors, we knew we had to do something like this. So the LP side, yes, is less risky, but you don't have as much upside and you don't get those tax benefits. On the GP side, we are drilling very low risk wells, like I mentioned earlier. So the liability is there. You have to know about it, but it is very, very small. Next slide. Now we're going to get into how it works, and I'm going right back to Laura.
All right, thank you, Jeff. One of our most unique opportunities actually has been this partnership that we've forged with T0. T0 is a wholly owned subsidiary of Overstock.com, and what they do is that 90 days after the close of the fund, they tokenize your ownership in the yield fund, and then they take those tokens and they list them on a secondary trading platform so that you can potentially trade in and out of our asset. This could afford the opportunity to provide expedited liquidity prior to the end of the fund's life, which Jeff mentioned is approximately 3 to 5 years. And then most importantly, how does this all work? So you go to EnergyFunders.com, you tell us a little bit about yourself, link your bank account, get verified through our third-party vetting group called Verify Investor, and then you can invest like that, just click of a button. And then, of course, we'll keep you up to date with our fund status on the digital platform. So there will be information about which wells you're invested in, which mines you're invested in. It's very slick. We've spent a lot of time and effort trying to make it as smooth as possible. And then, of course, the last benefit is that if when we close the fund, we can trade in and out of it using T0 if you're interested in something like that. And if not, then you just hold on to it. So with that, we're obviously very happy to answer any questions. We're here for you guys. We've got Jeff's contact info, Rouse's contact info, and then you can always reach out to any of us on LinkedIn or anything like that. And I think actually we're going to have a quick little video, if I'm not mistaken, right, Jackie? We're going to show a video of our Parker 10 well, the well that Jeff just mentioned, and just do that real quick before we start our Q&A. Thank you, Jackie.
Hey, Energy Funders investors. This is Laura Palmer, CEO of Energy Funders, sharing some fun and exciting news today. We just finished drilling our first proven undeveloped well in the Yield Fund, the Parker number 10. This new well is uphill from an existing well that produced about 300,000 barrels of oil over its lifetime. We hit our final depth about 5,600 feet below the surface of the earth on Thursday at the Parker 10 well. Once we hit final depth, we cleaned out the hole and began what we call logging. During the logging phase, we put technical tools down the wellbore to determine if there's an indication of oil, gas, or water. Once the data has been gathered from the tools, we analyze it to determine the quality of the reservoir and the presence and type of fluid. This will generally tell us if there's oil in the rocks that we've been targeting. The log data from the Parker 10 well have so far indicated a few interesting things. First, our tools measured very high permeability and porosity. This means lots of tiny holes that are connected up to contact as much of the reservoir or the rock as possible. The more holes and the more connections, the better. This means oil flows more easily to the surface and thus gives you better economics. Second, there is no indication of water in the formation. That's good because water in the pore space means you do not have to dispose of excess water along with the oil that comes out of the well. Excess water can be a drag on economics, so we're always pleased to see low water potential in the logs. The third and most important thing that we noticed was that there are, in fact, indicators of oil in the formation, and not just a little bit. There were several feet of indications that oil was present. This, in conjunction with the high porosity and permeability, that means we have a good chance of hitting a great producing well. Of course, this is a simplification, but we at Energy Funders and the geologists and engineers at Paleo Oil are all very excited to see the early results of this well. Next, we're going to test the well's potential to produce oil and begin the completion, which is when we perforate holes in the casing to access the formation to get them primed to flow. Once the completion is finished, we will hook it up to a pipeline for oil sales, which will generate revenue for Energy Funders investors. We're thrilled to have a new productive well as a part of our Yield Fund I. Talk to us about joining our fund so you can take advantage of investments like this. Thank you.
All right. Well, with that, I think Jackie's going to walk through all of these questions one by one and ask our team, and I will nominate everyone when it's their turn. So, Jackie, you want to get us going?
Yes. Sorry, I think we're getting a little echo here. So Arnav, thanks for your question. Can you get the same GP tax benefits against active income if you buy a GP interest through an LLC to cap the liability? That's a complicated question. I don't know if you need extra clarification from Arnav.
Yeah, I think Matt can take that one.
Yeah, no, that's a personal investment decision. I mean, that would be something you would construct on your end.
you'd have to create an LLC for this benefit, and then use that LLC. You would contribute the money to the LLC, and then the LLC would invest as a general partner. How it would roll through to your personal tax statement, you'd have to confirm everything with your own tax accountant to set this up, but I believe that would work. But again, everybody has their own tax scenario and their own tax situation, so you do need to, consult either your attorney or your tax accountant. But I have seen that before.
Thank you, Matt. Okay, next question is from Aaron. Will the T0 secondary shares include tax benefits for the secondary purchasers? And how will the tax documents be distributed?
Matt,
I can do this one as well. Okay, so you're the initial investor here. The tax benefits would flow through to you. You would have the benefit on your tax return. If you sold it immediately before that tax period ended, you'd have your basis net of what your proceeds would be. That would trigger either recapture of what benefits you had received if you sold it effectively for what you had contributed it for. But let's say, and then no, the investor that bought your interest would actually have all in leasehold interest. The initial investor is the one that gets the IDCs, ICCs, tangible equipment deductions, stuff like that. The subsequent investor is buying a placehold, and so what they would be buying is a leasehold interest.
Great, thank you.
Laura, do you want to take Aaron's question about when we're purchasing the Bitcoin miners, and what is the thought on timing on when the mine will be set up?
Yes, we actually did just make a purchase for the miners. There are supply chain issues, but we don't need to have ours set up until probably first quarter next year sometime. So we're in the process of getting moving on this, and there are some issues, but there are ways to mitigate some of those issues.
All right, that's great. And we have some questions from Fred about how many wells are in the initial fund and whether they're new drills or workovers.
Yeah, hi, Fred. We are doing a combination of new drills and workovers. That's PUDs and PDPs. And then we are targeting about 10 wells in the fund, but it depends on how much funding we're able to raise. We're trying to make sure that we're living within our means here. So right now, I believe we have 6 wells in the LP and maybe 4 wells in the GP. I believe that's close to right. So we've been making moves to make sure that our investors, our early investors, were taken care of and that we were actually putting the capital to work. I don't want the capital sitting around. So we've been buying fractional shares of wells for quite some time.
All right, next question. We got a similar question from both Salmon and Jason about what is the decision on fund life of 3 years versus 5 years, and what are your decision markers that help guide when we will close the fund or exit the fund?
Yeah, we're aiming to have a 3-year fund, but of course it depends on what the market looks like. So we're going to continue to evaluate that as we move forward with the fund. If the market starts to look really hot, we'll probably start to sell off some assets. If it doesn't, we'll maybe wait a little bit to see, but it's all a moving target. I'd like it to be shorter than 5 years, and that is the longer term goal.
Okay, and any other comments you want to make about the overall strategy to reduce risk and keep the value during that 3 to 5 year window?
Yeah, I mean, that's all going to be based on what financial drivers there are in the market. Matt and I are going to be working very closely to determine when the appropriate time to go through some sort of divestiture would be for most of our assets. That's something we keep an eye on all the time. I mean, it's basically portfolio management, just like you would have at any large oil company.
Okay, and a follow-up question from Arnaud about the GP and the LP having different assets. So you mentioned there were different wells in each side of those two funds. Can you clarify more on that?
Yes, I can. So the GP and the LP do have slightly different assets. The reason for that is that we know that our GP investors typically are more interested in the tax deductions. So we're trying to weight the GP more heavily with PUDs undeveloped locations so that those drilling, the IDCs, the drilling costs can get allocated over primarily to the GP. The LP, we weighted more heavily with existing production because we know that our LPs are more interested in getting that sort of consistent yield out of that, where they're a little bit less worried about having the tax deductibility of a PUD.
All right, excellent. And then we have an earlier question from Salmon. How does OPEC and the recent announcements about increasing supply have implication on our fund's IRR?
I'm going to nominate Ross to answer that one.
Yeah, I mean, it's so hard to make a short-term call on markets. I mean, no one really knows. OPEC, they're talking about, adding more production this month. Next month, it could be cutting. I think if you have a 3 to 5 year time view, the real big story here is that demand is coming back much stronger than many expected. Inventories, both in I think the U.S. inventories are at a 5-year low. Globally, they're also very low. So it's still a very bullish setup. I mean, anything can happen, but the capital impairment story plus the robust demand, I think, is, if you have a long-term time horizon, I think things still look great from our end.
That's great. Thank you.
Okay. And Laura, maybe this next one from Jason can be for you. Who manages the production of the well physically on site? And what uptimes do you calculate?
I assume this is relating to the Bitcoin mine, Jason. The operator of the well, which is Paleo Oil, will be in charge of maintenance on the well. Uptime we've factored in, I believe we used either 90 or 95% when we were factoring in our uptime. And that's because we were trying to be very conservative when we built out our Bitcoin mining model. Some buddies of mine colloquially told me recently that they were experiencing closer to 98% uptime. So it all depends on how well you're pumping your well and how well the well is producing, as well as how well the generator is running and if it's optimized or not. I think that's what you were asking. But typically, so in an oil and gas scenario, the operator on record would be the one taking care of the wells. I noticed one that we missed, Jackie, which was, do we have third-party vetting of the reserve reports? And the answer is yes. We do have a third-party group that vets that double checks all of our reserve reports.
Yeah, that was the question from Arnaud about our PUD is certified by independent reserve reports.
Yeah.
And yes.
Right.
Okay, so there's a follow-up question from Arnaud about the Bitcoin mine. About supply, install, operation, and maintenance. Where's the mine supplied from and who will run it?
Yeah, so we're building these mines ourselves. It's very difficult to find a turnkey person who will do a good enough job. And since we're fiduciaries, we want to make sure that we're doing the best job that we can. That includes purchasing immersion units for the mine. Those are the best right now. And so we're trying to make this as efficient as possible. Let's see what else. We have several different vendors who are providing us with all of the pieces of the mine. And then internally, we are hiring someone to come and be kind of the mine manager. So Piyush Prakash, who you saw on the first slide, he's our CTO. He has experience in doing this. I run a mine up in Wyoming on one of our well sites before. So we have some team members who have experience, but the longer term plan is to hire someone to be dedicated to management of the mines from both the software side, the nerd side, and the other nerd side, the engineering side.
Okay, and we had an earlier question from Arnaud that I don't think we answered. Is there an incentive distribution right structure to GP units holders, or both GP and LP units holders receive the same distributions? Matt, why don't you take that?
Yes, there's no incentive structure, no delineation between the split of the proceeds. So the LP, if they invest, $1 million, would participate on the same level on the distributions as the GP that invested $1 million. And then Arnaud had another question earlier. That 200 barrel well is actually owned by both the LP and the GP. The GP owns 50%, I believe. And
yeah, that's right. It's 45.
The LP owns 37.5%.
Right.
Yes, and I just want to say also, there are several documents posted in this chat at the very top of the chat There are several different PDFs you can download. We have a tax benefits ebook that explains a lot more of the tax benefits in detail, plus a few other documents. Any additional questions? Feel free to type them into the chat.
I do want to just mention that right now, most of our opportunities are in Texas. We do that for a number of different reasons. Texas is very regulatorily favorable for oil and gas. We have deep connections down here, and so our deal flow is really excellent in South Texas. We have a lot of access to deals that nobody else is getting. And of course, because price has been depressed for so long, there are a lot of operators out there who are, for lack of a better word, getting pretty desperate to go drill wells. And so it affords us an opportunity to take advantage of some of those situations. So we're very Texas friendly over here at Energy Funders. And yeah, Jason, we will provide a copy of the slides. I think Jackie just put those in the chat. And I think we're posting them on the website soon as well, Jackie, right?
They'll be on the website next week.
Perfect. We are going to save out a recording of the webinar. And then, of course, there's lots of other documents in the chat that you guys are more than welcome to download. Those will also all be available on the website. Yeah, Salman, we're working with a tax attorney right now to answer that question. So I'm honest, when we'll have clarity on the tax deduction treatment, that should be within the next day, I would hope. Ginny and I have been working diligently to try and determine what the answer to that is. Yeah, no problem. Cool.
One thing to clarify is that the Yield Fund I is open until 12/31. So
that's the current plan. We're planning to close it at the end of the month. We do have some new offerings coming out in January, but the current Yield Fund will most likely be closing toward the end of the month. Yeah, thank you, Jackie. Cool.
Any additional? Oh, Salmon wants to know, when will the second well be going live?
The second well. Yeah, we are teeing up another well right now. We are working with a drilling contractor to get it going, hopefully before the end of the year. The other important thing to keep in mind is that for these active deductions, you can actually drill until March 31st and still get the deductions from that drilling for the previous year. So any wells that we drill between January and March, you also get deductions for. So we are in the process of hopefully spudding the Barbados #2 well here in the next, I would say, 2 weeks or so. You know, of course, barring other issues, but that well will be coming online very soon. Great, no problem.
Any additional questions from anyone?
And yeah, always feel free to reach out.
You will all be getting an email later today with a link to the recording of this webinar, plus a bunch of documents.
Awesome.
There's a question about tax documents.
Yes.
Yes, you'll get a K1.
Those are all provided digitally on our platform, and you get a K1 at the end of the year, or no? Cool.
One of the things, can you hear me?
Yes.
All right. One of the things I think needs to be reminded is this is a very unique opportunity, and it's perfect for the time that we're in. So if you want tax deductions and you want to get a look at how oil and gas is done, you know, usually oil and gas has been a good old boys club, and it's harder to get at the wellhead, and the best place to be to enjoy these increase in prices, which are obvious, is at the wellhead, and we offer you that. So I do think even coming in at the minimum of 5,000 should be exciting for you to see how the Bitcoin mine world works and the oil and gas world works. And more Bitcoin, fantastic, Fred. You will get that opportunity next year. I promise you. We will have a Bitcoin only fund available. But I do think the yield fund, you're already investing in a 200 barrel a day well. If you get in before the end of the year, you get that access, and you get the access to your taxes. So although there's a ton of questions, and obviously there's always risk with something new, but I think this is a very low risk opportunity where prices are and where the economy is right now.
Mm-hmm. Yeah. Thank you, Jeff. I think that's the perfect way to wrap us up. What do you think, Jackie?
Yeah, that's great.
All right.
Take note of the contact info here. If you've got follow-up questions about investing, reach out to Jeff or Ross, and we'd love to have you join us.
Awesome. Thanks, everybody.
Thanks.